Today is Friday, September 2nd, and this is the ADM Investor Services Weekly Market Review. Today's guests are Alan Bush, Senior Financial Economist here at ADMIS, and Steve Freed, VP of Grain Research. Steve, what is the market looking for from private estimates for the USDA September crop production estimate, and what could be the market reaction from the USDA September 12th report?
In August, the USDA estimated record yields and record crops. So since then, the conversation has been that maybe the corn yield isn't quite as big as the USDA said in August, and that maybe the soybean yield might be just a little bit bigger. So I think the market reaction would be everyone's hoping that if they bring the corn yield down, prices might bounce off this contract lows. If they don't raise the bean yield and raise demand, maybe beans might bounce a little bit too. So actually we're looking for maybe a little bit of a friendly report.
Is this a bottom or only some buying in an oversold position?
A tendency for years in which we have big crops, we make bottoms on October the 1st. So we might be a little early to say that it's a bottom, but we're trying to find value here. A big ag bank this week came out with their monthly review, and they said both corn, bean, and wheat prices are near value, and that may be near a bottom because they could be stimulating demand and maybe reflecting most of the bearish news at this time. So I would say we're close to a bottom.
The U.S. has seen good weekly bean and corn export sales. The USDA is estimating that combined U.S. corn, bean, and wheat 2016-17 exports will be record high. Is this enough to rally prices, or will record supply limit gains?
I think it's enough to stabilize prices. You can't get away from the fact that farmers have a record amount of grain that they have to sell this year, but I think that grain has to move into the pipeline to satisfy the demand. So it may not push prices higher, but it could actually help like spreads rally, or you could have an opportunity if you're an end user or a farmer to buy a call, and if the market rallies, you can take advantage of that.
And this week, farmers and ag companies converged in Boone, Iowa for the annual Farm Progress Show. What were farmers feeling at the show?
Well, they didn't want to talk about markets. They were disappointed in prices. And I think in general they had a new toy that they looked at. It was a driverless tractor by Case. And it seems like, I'm a farmer, we own a farm, and I would love to have one of those. I don't know if I want to spend the money to buy it, but it would be great to have. But I think technology continues to improve yields, and technology is probably ahead of demand, and so that's one of the things that farmers are kind of looking at as maybe a negative to prices. But I think that at the ADM tent, at the ADMIS, they try to talk about how to own grain that you may have sold or take advantage of something, and so that brings up buying calls, buying spreads, things like that. So you want to try to think of ways to add to your bottom line and potentially of a bounce in prices, not necessarily a rally, and see if after the harvest we get a little bit of bounce in prices.
Great. Alan, the U.S. dollar advanced to a 3-week high on Tuesday after Federal Reserve Vice Chairman Fisher made comments that suggest that the Fed is moving closer to increasing its Fed fund rate. Its hawkish comments were somewhat tempered. However, when he said incoming economic data will determine the path of interest rate increases. What is the outlook for the U.S. dollar now in light of the weak U.S. employment data?
Well, it looks like the data is not quite as friendly as the Fed had hoped for, with today's employment numbers coming in virtually across the board on the weak side. Non-farm payrolls were weaker, private payrolls were weaker, manufacturing payrolls were weaker, hourly earnings, a whole host of economic numbers on the weak side. So that put some initial pressure on the dollar index, meaning that rates would not be able to be increased anytime soon. And yet, miraculously, the dollar now has traded higher. So clearly, traders of foreign currencies and the dollar index believe that even though the Fed may delay a rate increase, it does look like the Fed is the only central bank that is in a position to raise rates. Probably not this year, but potentially sometime early next year.
After an almost $330 rally from the December lows of 1046 to the early July highs of 1375, gold futures have recently come under selling pressure. What is the reason for the decline and what is the price outlook?
Well, the decline was primarily due to all of this hawkish commentary that we had, especially from, as you mentioned, Vice Chair Fisher. So that was a big negative, and it caused the gold market to come under pressure for the last month or so. But today, with the employment numbers coming in on the weak side, suggesting that the Fed will not be able to raise rates anytime soon, and of course, interest rates and gold trade inversely. So there was a very nice rally in the gold market today. So we do believe that the main trend for gold is higher. The main fuel for a higher precious metals market will be inflation, which is starting out very slow now, but we think will gradually accelerate. So the outlook for gold and silver is very bullish, and I think we're in the very early stages of a multi-year bull market for the precious metals.
The 170 major support area in September 30-year Treasury bond futures has had several times over the past 2 months. Will it continue to hold, and can futures bounce off again of support to this critical support area?
Okay, 170 has been the bottom of a major congestion pattern, and we've bounced several times, and I'm inclined to think that this time it will not hold. One really negative sign was today's very bullish employment numbers, bullish in the sense that a weak series of numbers is bullish for the credit markets, and yet the bonds are 1.5 points lower, clearly not responding as they should have to a very bullish series of economic reports. So we're closing in on the 170 level in the September bonds. I think we will break through, and I think that rising inflation levels will ultimately be a major negative for the bond market. So I would continue to trade bonds from the short side, and I think this is just the beginning of a long period of lower prices for treasuries, especially at the long end of the curve.
Great. Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company. And please, everyone, have a safe and happy holiday weekend.